Good morning, ladies and gentlemen. Wonderful to be with you here today. My aim is, as usual, to provide you with a quick update of the economy's recent performance, but more importantly, to give you some sense of how the future is likely to unfold. The good news is that South Africa is in the process of recovering from the shock of COVID-19, from the shock of the pandemic, and of course, from the very, very destructive level 5 lockdown that was imposed in April last year. So the economy has started to recover. That recovery started in the second half of last year, and the growth momentum largely continued into the first half of this year. So the reality is, if you look at that bounce back, it's been fairly convincing, and it's generally been stronger and faster than any of the analysts out there anticipated or expected. The Reserve Bank called the recovery unusually strong, but we do need to see it in some kind of perspective. It is more a rebound. It's more that we're going back to where we were, and as we well know, in 2019, 18, 17, South Africa experienced anything but robust, accelerating economic growth. Good news, though, is that the rebound is almost complete. GDP by the end of June of this year was just 1.1 percentage points short of the pre-pandemic level. Unfortunately, we do know that in the third quarter, we've encountered a whole bunch of new shocks. We saw tighter lockdown restrictions, and damagingly, these included bans on alcohol sales and for a brief period there on sit-in dining as well. We're in the process of a rebound. That rebound is still very much uneven. It's really been carried by a couple of industries, and we are still seeing enormous pain in some industries, especially those industries where the nature of the business involves a high degree of human contact. All of these industries are still only operating at a fraction of their full capacity. So it's an uneven recovery among sectors. It's also been an uneven recovery among income groups, and that the pandemic has not been that disruptive to the highly skilled professional higher income earners, but it has been exceptionally painful to those in your middle to lower income earning categories. So the reality is that this is where we are at the moment. The good news is that from August onwards, we've had a situation where at least conditions improved. The third wave eventually ebbed, came to an end, and South Africa officially exited the third wave of COVID infections. We also saw the easing of lockdown restrictions. We're now back at level 1, starting the 1st of this month. And at the same time, at least relatively quickly, calm returned to those areas affected by the riots and the looting. And as a result of that, where in July, we saw production, sales, and income in all industries, literally all industries, plunge very sharply. We have seen an equal and a vigorous rebound in August. So the economy is getting back on its knees again after the shocks of July. It's starting to find its mojo again, and we have returned to growth in August. And our view is that that recovery will continue. Growth will continue, and we'll probably end this year on higher ground, even if we were to experience a fourth wave of COVID infections. The reason we think that it won't be that dramatic the fourth time around is that South Africa is making progress with vaccinations, and particularly among the most vulnerable population group, which is 60 years and older. What you really need at the end of the day is not just that this recovery continues, but that you get the type of growth that is strong enough to boost business confidence in future earnings sufficiently to encourage them to go out there, take the risk, raise the capital, and expand their operations and employ more people. These are the fundamentals that will bring about not just a sustainable and strong recovery in the property market, but also really a robust and healthy general economic environment. So let's have a look at what are the chances of us seeing that sort of recovery. Well, the answer is it's very slim. Okay, so if we look forward and we say, well, will we see these sorts of outcomes where we not just have growth, but we have growth propelled by increased fixed investment, which is really the act of expanding your operations if you're a company, and increased employment. And as a result, we get this virtuous cycle starting to develop. And the answer is it's highly unlikely. And part of the reason for that is that red line I've just showed you, and that is fixed investment. Now, fixed investment has been exceptionally hard hit by COVID-19, but it was on a downward slope and an extended downward slope before this pandemic struck us and before we were forced to basically shut off the economy and try and switch it back on again. And you can see here I show you the historical movements in fixed investment activity going back to 1994, and you can see the downswing and just the slow deterioration in fixed investment activity and ultimately the decline. And you can see that the rebound from level 5 lockdown has been very unimpressive. And we are still, by the end of the second quarter of this year, miles below the levels that prevailed prior to lockdown. But we actually have wiped out the type of spending, that we've seen for decades. We're back to basically 2006 levels. So fixed investment activity is still desperately weak. What's holding that back? Why are we not seeing the recovery? In South Africa, we have almost chronically weak and subdued business confidence. And a lot of that has to do with the 10 years under ex-President Zuma, the rise in corruption, the implosion in public infrastructure that ultimately, at the end of the day, raised both the cost of using that infrastructure and limited the capacity available for economic growth. And you can also see this when you look at the breakdown of fixed investment activity. Now we look at it between the private sector, the public sector, and the public sector is split between general government and state-owned enterprises. And you can see where the drag has come from in fixed investment activity. It's come from the implosion in capital expenditure by state-owned enterprises. And unfortunately, that limits the private sector's ability to expand, right? The most obvious constraint is electricity. We don't have enough electricity. Now, there's been some encouraging developments on this front. We have seen that under President Ramaphosa, essentially, that he has pushed for the deregulation of Eskom, and that process is underway. We have also seen that Eskom got a new CEO. There are attempts to undertake deep maintenance. It's not going very well. That has to be said. It's not going very well at all. There are all sorts of rumors of sabotage, repeated sabotage, and so forth. That might be the case. There's certainly been no case laid in front of the law enforcement agencies as far as that's concerned. But whatever the case may be, deep maintenance not going really well at Eskom. And we constantly, as a result of that, still have load shedding. So we have electricity shortage, and it's very difficult for a private company to expand its operations when it doesn't have access to power. Power is not a luxury, it is an essential for economic growth. Now, at the same time, of course, in response to this acute electricity crisis, which if we wait for Eskom, is unfortunately not going to be resolved over the next 5 to 7 years, maybe not even the next decade. And so in response to that, President Ramaphosa have gone about lifting some of the regulatory requirements on who is allowed to generate electricity in South Africa, and he has made a concession of 100 megawatts of embedded generation, which means that companies can put up to 100 megawatts of their own generating capacity in place. Now, that is a way around the electricity constraint, but it's obviously not going to lift it immediately. It's certainly not going to lift it for the rest of this year or next year or the year thereafter. Slowly and surely, you may see a situation where more companies can sustain their own power, will put in that capacity, and therefore will not be subjected to normal disruptions on the grid, but that's going to take time. So in the interim, we have not sufficient electricity, so it's still going to constrain expansion activity in the private sector. We've also got rising electricity costs, so that just raises your hurdle rates for new projects going forward, also discouraging fixed investment in the private sector. And the sad thing is not just electricity, it's also our mix of transportation between road, rail, and port infrastructure. There are big shortages and backlogs as far as that infrastructure is concerned. And at the same time, it's unreliable and it's also very expensive. So our general economic infrastructure is just not conducive to expansionary economic activity and to fixed investment. And it is for this reason that we don't think fixed investment is going to be a major driver of economic growth going forward. So we're not going to get that virtuous cycle. So does that mean we're doomed? Well, there are at least some positives that will help carry the property market forward over the next year, even over the next 3 years. And that is the fact that consumer spending, household spending, that has rebounded quite nicely. As I've said before, it's been one of the key drivers of the recovery we've seen so far. So consumer spending has recovered plenty of lost ground, but it now appears to be drifting sideways a little bit. It looks like things are stalling a little bit as far as that's concerned. Now, the key driver of consumer spending is, of course, disposable income at the end of the day. And income itself is a function of employment and wage growth. So now let's have a closer look at those two and see how they're likely to play out. Now, the reality is what we think is happening to disposable income, and the reason we think that disposable income is now starting to drift sideways is because we're not getting sufficient employment creation. Conditions in the labor market is absolutely horrendous. It's really shocking. It's staggering how weak it is. And this graph really tells you the story of South Africa's labor market. Here you see employment in the private sector, that's the red line. You see employment in the public sector. You can see during the Zuma years how the state just exploded and became the biggest employer in this economy. But of course, governments don't generate wealth. It relies on taxes that it generates from the private sector. And as the state expanded, the private sector shrunk. And you can see how private sector employment has been stagnant for an exceptionally long period of time. And that also meant that we had less final taxpayers that had to fund this monster of a state. And so the state's ability to create jobs was constrained by running into financing issues, budget constraints, mounting public debt burdens. And so it started to drift sideways. Now you can see in the second half of last year and the first quarter of this year, public sector employment actually increased. So they didn't limit employment. A big portion of that is the president's job creation plan. So there's been some success as far as that's concerned. But the reality is that the public sector can't drive employment creation. It's already too big for the size of this economy. And so this is just not sustainable. So we think that job creation at the end of the day in the public sector will start to level out. Well, we don't believe they're going to retrench people en masse, but it will level out and it will remain fairly steady. So they're not going to be providing the recovery in jobs that we need to provide momentum to household income and to consumer spending and to confidence and, of course, to demand for property. And what we've seen is that the main drag is coming from the private sector. Look at that. That red line just dropped and it hasn't recovered. It's still hovering around at that trough. And there's been no real sign of any uptick in employment. Now, we do expect this will improve as long as the economy continues to grow, as the impact of lockdown starts to fade because a greater and greater percentage of the population is vaccinated. Ultimately, companies should get to that point where their finances have been improved to such an extent that they can now start to employ people again. So we do think we'll get there. We'll see slow gains in employment. But what is creating this sort of stagnation, where we're not seeing any upward traction, is really the absolute hit we have seen to your high contact industries. This is now essentially your restaurants, your pubs, your other forms of food services, hotels, other accommodation, travel, tourism. And this graph really just shows you. If you look at the black line, that's essentially restaurants and pubs. Well, retail sales, wholesale sales, and even new vehicle sales have pretty much returned to pre-lockdown levels. That's not the case for restaurants. That's not the case for hotels and other accommodations. Restaurants are operating at 68% of their capacity, all right? And it's even worse for hotels and accommodation because they rely on foreign tourists returning to South Africa in large numbers. and they're operating at just 35% of their capacity. And what we've seen is that been in this condition for 18 months, and that's too long. Some companies cannot take the pressure anymore, and so we're seeing liquidations and insolvencies increasing. Companies are closing, they are folding, and therefore unemployment is now starting to rise again. And that is what is hurting private sector employment in our view. And so there is a solution to this. The solution is that we get the bulk of the population vaccinated, and that we avoid the sort of lockdown that really kill these sorts of industries. But of course, a lot of damage has already been done there. So it will take time for employment to recover. And employment is currently the drag on income. Wages have done better. So we have seen wage growth increase, not in the public sector. In the public sector, as you know, wages were frozen in 2020. This year, it increased by 1.5%. Inflation is estimated to be about 4.4% this year. So in the public sector, you're still talking about a real or inflation-adjusted wage cut. Going forward, we don't know what's going to be the outcome there. They will probably get more than 1.5% in the years to come. But the reality is that government has to try and reduce the budget deficit on a sustainable way. They have to try and repay debt in a sustainable way. And in order to do that, they have to tackle the public sector wage bill. So we don't think there's a lot of upside for public sector wages. So again, it's the private sector that has to do the heavy lifting. Now you can see private sector wages have bounced back. Earnings in the private sector have certainly bounced back quite significantly from where it was, but it's still not back to pre-pandemic levels. And even prior to the pandemic, private sector pay has stagnated. It's been on a long-term downward trend. We do think it will go back to where it was in 2019, and thereafter it's an open question. Thereafter, it's a function of us continuing to get economic growth. So we see marginal employment gains coming through, and we also see continued improvement in private sector pay, and that's going to provide a bit of a lift to disposable income. It could be a lot better than we think if foreign tourists return to South Africa and your hotels, tourism, and restaurant industries manage to recover. Remember, they're very labor-intensive industries. And so if they recover, it could provide a nice lift during the course of 2022 and into 2023. So overall, this is a bit worrying. It's not a convincingly positive story, but at least it is looking a little bit better, and it should continue to support, and it should continue to improve rather, and we should hopefully at some point get that lift coming through from a recovery in your high social contact industries. But there is more good news for consumers, and that is that they're generally sitting with fairly healthy balance sheets. Okay, so whatever challenges they face in the months ahead, they are at least facing them with much healthier balance sheets. We've seen significant gains in net wealth. This is because house prices have increased, but it is also because equity prices have rebounded and risen well above the levels we saw prior to the pandemic. A lot of that had to do with the surge in global commodity prices that benefited our resources stocks. But we've also seen widespread improvements in company earnings, and all of that, of course, bodes well for both employment going forward and for wealth gains. And so net wealth as a percentage of disposable income is well above pre-pandemic levels. And so that means that there are positive wealth effects weighing on households. So that's a positive. The other positive is that households have been very responsible throughout this crisis. They've kept their borrowing to a minimum. They have increased borrowing, but they've kept it to a minimum. And they've done that despite the fact that interest rates have been cut by 300 basis points, and that prime is in fact at a 56-year low at this point. And so the interest service cost on your existing debt burden has come all the way down. So all of this has also helped consumer spending. It has certainly helped to strengthen the financial position of households, particularly their balance sheet. And as you know, your balance sheet is an essential element towards applying for a mortgage, getting that mortgage granted, and going forward. So this looks good for the property market. The other thing that consumers have done is they have been saving, all right? So they've seen the cost of their existing debt drop. Those that work remotely have seen their expenses come all the way down because they don't travel anymore. They don't need fancy clothes, none of those things. So the expenses came all the way down. And that sort of windfall gain of additional money or funds available for discretionary spending, they have been partly directing towards savings, and part of it they have spent on other things like durable goods, like computers, like printers, and so forth. And also on buying property. So we have seen that. So that's quite encouraging for your market. But they have put a lot away in savings, so much so that last year South African households became net savers, and they remain net savers into the first half of this year. So that means there's this stash of savings that if confidence improves, and we see a little bit of momentum coming through in South Africa, some of this savings will be redirected to spending, and some of it might even go towards applying for a mortgage, putting down a deposit, and buying a new property. So this is also good for the property market. But at the end of the day, another key measure is, of course, what will happen to interest rates. And as you know, interest rates, that is a function of what happens to inflation. Now, South Africa has been incredibly fortunate on the inflation front. Inflation is a problem the world over. It's been the problem as a result of a lopsided global recovery, where you've seen a strong rebound in global demand in your advanced countries, where the bulk of their populations are vaccinated, and then in emerging markets, where the bulk of the population is not vaccinated, where COVID continues to circulate, and where lockdown is still needed, you have seen continued disruption. And the problem is a lot of the goods demanded by advanced countries are either sourced or processed or actually produced in emerging markets. And so what we've seen is that we've got this mismatch between demand and supply, and we've had this massive surge in demand for goods in particular, and it's just outpaced the world economy's ability to produce. And that has resulted in rising global inflation. It's quite interesting. In the US, inflation is 5.4%. In South Africa, inflation is now 5%. So South Africa's inflation is actually lower than US inflation. And that is not something that I would ever have thought I would say in my professional career as an economist. So that is where we are now. South Africa has actually been very fortunate, but our inflation has ticked up. It's increased from very low levels in May last year to 5%. And again, all of that inflationary pressure has come from goods. Okay, so goods inflation has been the problem, and a lot of that has been imported inflation. It's been due to global shortages, it's been to global supply chain disruptions, which of course is still all related to COVID, all related to lockdown, right? And we've seen it particularly manifest in global food prices. Global food prices have also been affected by extreme weather events, which is directly caused by climate change. And so we've seen that global food prices have shot up, and we've imported some of that price pressure on the food side. But to some extent in South Africa, it's been modest. You look at Latin America, you look at Asia, food inflation has been a major source of inflation. In our case, it's also been a source of inflation, but not that dramatic. And the reason is that our farmers had 2 fantastic years, and a bumper local crop has meant that we didn't need to import that much, and that contained the impact. The other thing is the rand bounced back very nicely, and that also contained food inflation. So yes, global food inflation is a problem, but at this point, it's not been as dramatic in the case of South Africa than it has in the case of many other countries. Another source of inflation has been oil prices. Now, oil prices have more than recovered from the lockdown-induced slump. They have, in fact, shot above pre-pandemic levels. This is a highly manipulated market. It is not a free market. OPEC decides on their quotas, and they have been quite unwilling to increase their quotas more. In November, we will see supply increase, and hopefully we'll also then start to see prices moderate. And so there's all sorts of shenanigans at play in this market, which is putting pressure on oil prices. But generally speaking, it's not expected to last, because at some point or the other, they will have to up supplies. And as they do so, ultimately oil prices will start to moderate. It may not decline. It may stay elevated at high levels, but it's certainly not going to continue to climb and continue to climb for the next 12 months. Our view is that it will stay elevated for the next 6 months. It will be a source of inflation for South Africa, and thereafter it should start to moderate. So it's been a source of inflation, again, imported. The other worry for the Reserve Bank is that the Rand could come under pressure. As I said, the Rand has been a pressure relief valve. It's acted in that capacity in terms of global inflation. So while we've seen surging global producer inflation and even consumer inflation, the Rand's recovery from April last year have to a large extent neutralized or countered that rise in global prices. But the Reserve Bank is worried that that won't last. And with the Rand, it's always possible. It's the most volatile currency in the world. And the fear here is that we know since inflation, have returned to the world economy, and it's been particularly significant in the United States, we know that they are now in that position where they're starting to consider withdrawing their monetary stimulus. So they're going to start acting against inflation. The first step will be to taper US bond purchases. In other words, to start to mop up all that liquidity they pumped into the system. In other words, they're going to be withdrawing dollars from the system. And if there's less dollars in circulation, then of course it means the value of the dollar rises and all other currencies against the dollar will come under pressure. So that will be the impact of the scaling back of quantitative easing. Then eventually they will start to normalize the interest rates. Now what happens then is that to risk-averse investors, the US, which is considered a risk-free destination, will offer a higher return. And you will see some investors will take that up. They will refrain from coming to high-risk countries like South Africa and Brazil. Why take that risk if you can just put your money in the US and you'll get a higher return because interest rates are going up? So capital flows could come under pressure to emerging markets, and once that happens, the Rand could also come under pressure. So it's because of the normalization in US monetary policy in particular that the Reserve Bank is concerned about what could happen to the Rand. And if the Rand comes under pressure, of course, and you still have rising global food prices, rising global oil prices, rising global cost on all intermediate goods from semiconductors to whatever, you still have the disruption from COVID in the world economy, you still have lockdown, then suddenly a weaker Rand will amplify that effect in South Africa. And it's because of that that the Reserve Bank is saying, wait a little bit, we're going to have to start normalizing interest rates. And they've said that repeatedly. And they are planning, their models suggest that they need to hike rates by 25 basis points in November, another 100 basis points or 1% if you prefer in next year, and then another 100 basis points or 1% in 2023. So that would take your repo rate back to about 6.5% from 3.5%, and it will have an equivalent impact on your prime rate. So your prime interest rate would go from 7.5 to 9.5%. to put it into some kind of perspective, which is still below the levels that prevailed prior to lockdown, right? So it is still a fairly attractive rate, but that is a fairly aggressive increase. And we don't think that at the end of the day, we will see interest rate hikes to the extent that the Reserve Bank's model at this point is suggesting. And the reason we don't think we're going to see that is because demand in South Africa is still incredibly price sensitive. Speak to any manufacturer, any wholesaler, any merchant, any retailer, and they'll tell you to move volume in South Africa, you have to discount. So we are incredibly price aware as a public, and that means that retailers do not have pricing power. They can't just pass cost increases onto the consumer, regardless of where those cost increases come from, without hurting their sales volumes. And that is why we do not believe that inflation will run away in the case of South Africa. We think we're going to see a spell of higher inflation over the next 6 to 8 months. And then by around June, July next year, it will start to taper off, start to moderate, and eventually it will return to the level that the Reserve Bank is targeting, which is 4.5%. All right. So in that context, yes, the Reserve Bank's model is suggesting that rates should go up by about 250 basis points from November this year until the end of 2023. But we don't think they're going to be able to push that sort of rate increase through. And the reason we don't think that's going to happen is because we think inflation will behave and it will come down to 4.5% sooner than they may anticipate. And so what we see is only 100 basis points next year, no rate change this year, then flat for an extended period of time, and then in 2024, we see another 50 basis points. And that literally is it, of whether we see the Reserve Bank scenario or our scenario. At the end of the day, interest rates are not going to go back to the sort of levels where it will seriously derail any kind of consumer spending. But of course, under the Reserve Bank's number, it could slow credit demand. Under our number, we don't think it's going to have any major impact on credit demand. So in our view, the fundamentals for continued growth in residential property is there, right? You have households sitting on strong balance sheets, positive savings. Yes, employment and earnings dynamics, not fantastic, but should arguably improve from these low levels until it's normalized. And you still have a contained inflation picture, and you have modest increases in interest rates you're facing. And that's why we believe that house prices will hold up. There you see house prices have been flat for an extended period of time. Actually, during COVID, we saw a pickup in demand for property, and especially in first-time buyers. At Nedbank, we've seen a big increase in first-time buyers, and that has pushed up property prices a little bit. We now have a situation where property prices are growing at around 5%. And for the first time in many, many years, it's positive in real terms. Now, if you look at F&B's index, it's suggesting it's starting to lose a bit of momentum. If you look at Lightstone, though, it's showing a far more robust number. So the truth probably somewhere in between, that it might be drifting sideways a bit, but it's still, generally higher than it had been throughout 2018 and 2019. And in fact, we think that it will recover. We think that it's really households that will drive growth going forward. And this is what we think will happen to mortgage growth. We think it will remain fairly robust going forward and then starting to moderate. And unfortunately for commercial property, we don't see quite a similar picture. There it's going to remain fairly subdued. It will eventually improve from this low base, but we've got big structural changes happening there, and we've got an environment that is still not favorable for fixed investment activity. So overall, it's a mixed picture for the property market. The prospects for residential property looks quite good. For commercial, it looks quite challenging. Overall, though, the good news is that we are slowly moving in the right direction.